Investing is one of the most advised ways of making money, but there are a few more ways in investing where you can make a good sum of money, possibly investing less and turning up a huge profit. One of such strategies is value investing. Never heard of it before? Don't worry, this video has you covered. So before any further ado, let's dive into the video. Value investing is nothing more or less than buying investments on sale. The origins of value investing go back to research by Benjamin Graham and David Dodd in the 1920s, when both men began teaching at Columbia Business School. Many of the concepts of value investing are described in their book, Security Analysis, and in Graham's book, The Intelligent Investor. Warren Buffett, the most successful practitioner of value investing, was a student of Graham's at Columbia. Value investing starts from the premise that an investor who buys stock in a company owns part of the business. While this may seem obvious, many investors play the market without regard to the underlying fundamentals of the companies they own. As a business owner, the investor should evaluate the financial statements of companies to assess their intrinsic values. This type of evaluation is known as fundamental analysis. Intrinsic value is rarely a single number, rather due to the many assumptions that go into valuing a complex enterprise. Intrinsic value is often a range. This lack of precision shouldn't concern an investor. In the words of Mr. Buffett, it is better to be approximately right than precisely wrong. Value investors will consider investing in a company whose price is at or below its intrinsic value. So, how do you calculate intrinsic value? Fundamentally, calculating a company's intrinsic value involves determining the present value of a company's future cash flows. This, in turn, requires estimating future cash flows and the interest rate to use to determine the present value of those cash flows. Given these assumptions, it's easy to understand why intrinsic value is often a range rather than a precise number. Buffett called intrinsic value the only logical approach to evaluating the relative effectiveness of investments and businesses. There are a number of metrics that some use to determine whether a company is selling below its intrinsic value. While none of these should be relied upon blindly, they can be a helpful starting point. Price-to-book ratio, a measurement of a company's value compared to its share price. If the price is less than the value of the assets, the stock is underpriced, assuming the company is in reasonable financial shape. Price to earnings outlines the company's earnings track record to see if the available share price isn't accounting for all earnings. Free cash flow, the money generated from a firm's revenue or operations after subtracting expenditures. It is the cash that remains when the company pays expenses such as capital expenditures and operating expenses. Other salient factors include analysis of sales, revenue, growth, debt, and equity. You must also consider an organization's business model, target market, brand, and any competitive advantages it has. Now let's talk risks. There is an element of risk to every form of investment, and value stocks are no different. The first thing to remember is that you are relying on your reading of the company and the market. If you dive in without performing due diligence, you won't like the outcome. If you invest in value shares in a volatile market, the price of your investment will rise and fall at extreme speed. You may find a company whose share price has tanked. You believe now is the time to buy, but to your horror, you learn that the market's volatility caused the price to crash even further. In some cases, the price never recovers. In a volatile market, you have little time to react if things go badly, and they can go wrong in a hurry. That is why Graham and Dodd always preach the importance of finding solid companies in a stable industry. You have to consider factors such as law and regulation, tax forms, and other global changes. If the overall performance of the financial markets hits a downturn, there could be dire consequences for companies, which hurts their value. Imagine investing in a marijuana company in California only to find out that the state has decided to rescind previous legislation allowing legislation. And that's it for today's video. Don't forget to like, subscribe, and hit the bell icon to be notified of our next videos, and I'll see you in the next one.